So let's take the first step towards building a portfolio tailored to your needs with our first episode, Understanding Passive Funds. When it comes to investing, there are two philosophies, active investing and passive investing. Active investing involves selecting of individual stocks or funds with the aim of outperforming the market. Passive investing, on the other hand, aims to match the returns of the market by investing in a basket of securities that mirrors a specific index or a market segment. Let's understand a little more about each. Active investing is a strategy where an investor or the fund manager tries to beat the market average by selecting stocks and mutual funds or other investment vehicles that are expected to outperform the market. This approach involves conducting in-depth research and analysis of a company's financial statement, industry trends, and overall economic conditions to determine the stocks or funds that will perform well in the future. The goal is to create higher returns than the benchmark index such as Nifty 50. However, it is to note that active investing requires a lot of time, effort, and skill as it involves continuous monitoring and adjusting of the portfolio based on market conditions and new information which we get on the go. Additionally, active investing also involves higher fees as investors need to pay for all the work that we've done above, such as pay for research, transaction cost, the fund management fees, which can significantly eat into the returns that the fund provides. On the other hand, passive investing aims to match the returns of the market by investing in a diversified basket of securities that mirror a specific index or market segment. Passive approach involves investing in ETFs, which are also known as exchange traded funds or index funds that track a specific index or a benchmark like Nifty 50 as I told before. ETFs are a type of investment fund that trades on exchange like a stock. They represent a basket of securities that track a specific market index or a sector. By investing in an ETF, you are essentially investing in a portfolio of stocks depending on the type of ETF you choose. On the other hand, index funds are mutual funds that seek to track the performance of a specific market index, such as the Nifty 50 or the BSE Sensex. Fundamentally, one trades like a stock on the index, the other one is bought and sold as a mutual fund for your consumption. Like ETFs, index funds also offer investors a low-cost way to gain exposure to a diversified portfolio of stocks. Therefore, passive investing is a low-cost, straightforward approach that requires little time and little effort, making it ideal for beginners or investors who prefer a hands-off approach to investing. Instead of trying to outperform the market, passive investors aim to capture market returns by holding these stocks in a low-cost manner. There are various asset classes such as stocks, bonds, commodities that they can hold through passive instruments. One significant advantage that I would want to talk about passive investing is that it provides broad market exposure that reduces the risk of underperforming the market. Additionally, passive funds, like I said before, has far low fees that can help investors to save a lot of cost. This low-cost structure translates into higher net returns for investors over the long run. In summary, active investing involves attempting to outperform the market, whereas passive investing aims to match the returns of an index or a benchmark. One requires a lot of time and effort, the other does not require a lot of time and effort. Active investing, because it involves a lot of time and effort, is expensive in nature, whereas passive investing is not expensive because it tends to follow the benchmark. Now, let's take a look at some of the ETFs and index funds that are available to investors in India, present across various factors, sectors, and sizes. Some of the popular ETFs and index funds are the Nifty 50 ETF, the Nifty Bank ETF, the BSE Sensex ETF, the Midcap 100 ETF, amongst many others. There are some ETFs and index funds that also allow you to invest internationally, such as America and emerging markets, also help you invest in certain factors which range around value, momentum, and low volatility, amongst many others that exist.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.